We will be discussing various credits that can reduce direct tax liability. What are the peculiarities of the adoption tax credit? Adopting a child may result in taxpayers qualifying for either a tax credit or an exclusion from income for employer-provided adoption assistance. The taxpayer can claim a credit for any qualified adoption expenses they incur. In order to be eligible, a child must be under 18 years of age, or physically or mentally unable to take care of themselves. Reasonable and necessary expenses that are related to adoption, such as adoption fees, court costs, attorney fees, travel expenses, and other directly related expenses, are considered qualified adoption expenses. Child tax credit. Taxpayers with qualifying children are eligible for the child tax credit. The credit is only granted for tax years that last for 12 months. The definition of a qualifying child includes the taxpayer's child, stepchild, sibling, step-sibling, or descendant of any of these, or an eligible foster child. Eligible children should adhere to the following guidelines. Number 1, a U.S. citizen or a resident alien. Number 2, eligible for claiming a dependency exemption by the taxpayer. Number 3, individuals who are under 17 years old by the end of the tax year. For every eligible child under age 17. Limitations and attributions of the Earned Income Tax Credit. Individuals with earned income and gross income below specified thresholds can receive the Earned Income Credit. If married individuals file separately, they are not eligible for the credit. Individuals who have at least one qualifying child will see an increase in their Earned Income Credit. An individual without a qualifying child must have his or her principal residence in the U.S. for more than half of the tax year, be at least 25 years old, but under age 65 at the end of the tax year. She should not be dependent on another person. The Earned Income Credit cannot be used in taxable years starting in 2024 if the aggregate amount of certain investment income exceeds $11,600. The Earned Income Credit is decreased by any phase-out, which is determined by multiplying the applicable phase-out percentage by the excess of the amount of the individual's AGI amount, or earned income, if greater, over the beginning amount. Earned Income Credit is not available if AGI or earned income exceeds the phase-out amount that has been completed. Beginning income that has been completed and is eligible for phase-out. Qualifying for phase-out eligibility. Maximum phase-out amount needed. Education credits. Out-of-pocket tuition expenses can be claimed by students who are pursuing college, graduate degrees, or vocational training. Tuition, fees, and course materials are all included in the qualifying educational expenses. The credit is not allowed for room and board, insurance, student health fees, transportation costs, activity fees, or any other fees or expenses not related to the student's academic course of instruction. The American Opportunity Tax Credit, AOTC, is offered to each student, but the lifetime learning credit is calculated for each taxpayer, regardless of the number of students. During years where the American Opportunity Tax Credit has not been claimed for the same student, the lifetime learning credit is accessible. The adjusted gross income limitations apply to both the American Opportunity Tax Credit and lifetime learning credit. Qualified tuition and fees paid for can qualify for the lifetime learning credit. Number 1, taxpayer. Number 2, taxpayer's spouse. Number 3, taxpayer's dependents. Undergraduate, graduate, and professional degree courses, as well as courses to acquire or improve job skills, can be paid for with this credit. The credit can be claimed for any number of years. Premium tax credit. If you buy a health plan through the Health Benefit Exchange, you may be eligible for the health insurance premium tax credit. The premium tax credit is based on a sliding scale, and those with lower incomes receive higher credit amounts. In addition to income, the credit amount is impacted by the cost of available insurance coverage, the area where the taxpayer lives, and family size. If their household income is at least 100%, but not exceeding 400% of the federal poverty line for the family size, the taxpayer may be eligible for a premium tax credit. The credit is available to households with income above the 400% ceiling for tax years 2021 through 2025. Eligible taxpayers have the choice between receiving advance payments towards their health insurance premiums or receiving a regular credit at the end of the year. Insurance coverage purchased outside of the marketplace cannot be eligible for the premium tax credit. Joint filing is mandatory for married taxpayers. Thank you and God bless you.